Benjamin Graham's The Intelligent Investor is hailed as a timeless guide in the world of investing. This book stands out by drawing a clear line between investing and speculating, showing readers how to achieve success over the long haul. Graham emphasizes that investors aim for long-term results, while speculators chase short-term gains. A perfect example of this distinction is the 1929 stock market crash, where many speculators faced significant losses, yet patient investors who waited for the market's recovery ultimately benefited. Graham also highlights the importance of developing emotional discipline as an investor. Staying calm and composed in the face of market fluctuations is crucial. One of Graham's recommended strategies, dollar cost averaging, involves making regular investments to mitigate the impact of market volatility, offering a pathway to long-term gains. This approach allows investors to balance out costs over time by consistently buying, even when the market dips, without succumbing to panic. Now, let's delve into who Benjamin Graham was and the context in which this book was written. Known as the father of modern investing, Graham penned The Intelligent Investor in the mid-20th century. The book emerged during a period when the effects of the Great Depression were still lingering, and investors were seeking a safe harbor. Graham aimed to provide a solid foundation for investors, guiding them toward long-term success. Due to its historical significance, the book remains a go-to resource for many investors today. Turning to the main ideas of the book, Graham stresses the need for investors to examine financial history to assess future possibilities. His famous quote, "Those who cannot remember the past are condemned to repeat it," underscores the importance of historical data. This approach offers both defensive and enterprising investors a chance to develop robust strategies. Being a smart investor requires not just knowledge but also the right mindset. Graham advises investors to carefully evaluate stock prices when making purchases. He warns against focusing solely on promises of high returns, emphasizing the importance of comparing these promises with actual value. Investors should acknowledge risk factors and be prepared for market fluctuations. A strategy underpinned by knowledge and experience can yield more substantial returns over time. The book suggests that investors maintain a balanced portfolio of stocks and bonds. For instance, the proportion of bonds in a portfolio should range between 25% and 75%. If the market reaches dangerous levels, reducing the stock portion to 25% is sensible. During the late 1960s, when the DJIA index saw significant gains, bond yields also rose. Investors who shifted more towards bonds during this period often achieved better returns than those sticking with stocks. Here are 5 key lessons from the book that we can apply to our lives. 1. Develop emotional discipline. Adopt a calm approach to investing, avoiding emotional swings. This is the key to long-term success. 2. Value historical data. Assess future possibilities by examining past market movements and economic data. This can help you develop a solid strategy. 3. Create a balanced portfolio. Minimize risks and optimize returns by maintaining a balanced distribution of stocks and bonds in your portfolio. 4. Focus on true value. When investing, concentrate on the true value of stocks and be prepared for market fluctuations. 5. Invest regularly. Use methods like dollar cost averaging to invest regularly, balancing costs over time and achieving long-term gains. If you enjoyed this book, consider exploring these titles. 1. The Most Important Thing, Uncommon Sense for the Thoughtful Investor, by Howard Marks. Offers deep insights into risk management and investment strategies, expanding on Graham's principles. 2. The Little Book of Value Investing, by Christopher H. Brown. A perfect starting point for those looking to dive into value investing. 3. Think and Grow Rich, by Napoleon Hill. Focuses on financial success and personal development, providing inspiration for investors. In conclusion, Benjamin Graham's The Intelligent Investor serves as a solid and reliable guide in the investment world. By adopting strategies like emotional discipline, historical data analysis, and balanced portfolio creation, you can achieve long-term success in investing. Remember, investing is a marathon. Instead of chasing short-term gains, focus on long-term strategies. Armed with the valuable insights from this book, you can take more informed and secure steps in the investment world. Don't forget to subscribe and see you in the next episode.